Okay, so the market just got rocked by one of the most volatile Fed days we've seen in years. And you know what? It all came down to this perfect storm of inflation, geopolitics, and, well, just four simple words from the Fed chair. Today, we're going to break down exactly what happened, why it happened, and most importantly, what comes next. We'll walk through three possible scenarios and lay out a strategist playbook for this brand new reality. Let's dive right in. It all started right here. Seriously, four little words. When Fed Chair Jerome Powell was asked about how rising oil prices from the conflict in Iran would affect things, this was his answer. We just don't know. And in that one single moment, everything changed. The entire psychology of the market just shifted on a dime. You see, for years, investors have been working under this core belief, this unspoken rule, really, that the Fed would always have their back. It was like a free insurance policy for the market. But Powell's completely honest uncertainty, well, that just shattered the policy. Boom. The safety net was gone, and suddenly the market felt like it was in a total freefall. So you're probably asking, how could four simple words cause such a huge sell-off? Well, the thing is, they weren't acting alone. This was what we call a dual shock, where all these simmering tensions and bits of bad news all collided on the very same day. And man, you can really see the damage right here. The S&P 500 dropped almost 1.5%, and the Nasdaq fell even more. But the number that tells the real story is the VIX. You know, the market's fear gauge. It just exploded, up over 12%, hitting 25. That is a crystal clear signal of some serious investor anxiety. So let's break down this three-headed storm. First up, inflation decided to roar back to life. Even before Powell said a word, we got a producer price index report that was more than double what anyone expected. So inflation was already sticky. Second, geopolitics escalated and fast when Israel attacked Iran's South Pars natural gas field, which happens to be the largest in the world. And third, just as the market was trying to process all of this, the Fed basically stepped back and admitted they didn't have the answers. It was these three things hitting all at once that created the perfect storm. So that's what happened. That's the anatomy of the shock. But the real question on every investor's mind is, what happens now? Look, nobody can predict the future, but we can absolutely analyze the possibilities. So let's explore three potential scenarios for what could happen in the medium term. Now, what's really interesting here is that the most likely scenario, sitting at 55%, isn't the best case or the worst case. It's this middle ground called stalemate. What does that mean? Well, it suggests we're in for a period of prolonged tension with oil prices staying high, probably in that $90 to $110 range. And that means the Fed is just stuck in a wait-and-see mode. The more optimistic, diplomatic easing scenario, that's at 25%. And a full-blown escalation is at 20%. And this table, well, it lays out just how starkly different the outcomes could be. If we get the diplomatic scenario, oil falls below $75 and we probably see a big risk-on rally in the markets. But if we get escalation, oil could spike above $120 a barrel, tech stocks would get absolutely hammered, and investors would run for cover in defensive assets. And our base case at stalemate, it sits uncomfortably right in the middle. Good for energy stocks maybe, but it puts a ceiling on the broader market because of that stubborn inflation and uncertainty. Each of these paths means something dramatically different for your portfolio. Okay, so you're faced with all these wildly different paths. How in the world are you supposed to respond? The key is not to panic. It's about having a clear strategic playbook for this new risk-off environment. So let's walk through that right now. First things first, it's so important to understand the kind of sell-off this was. It wasn't just a gut reaction, emotional panic. No, this was what you might call a System 2 move. It was the market taking a step back and logically reassessing this whole new landscape. Investors weren't just selling because they were scared. They were selling because they concluded that with the Fed on the sidelines, the fundamental risks have truly gone up. And that distinction is everything. This slide really shows the difference, right? You've got two mindsets. The panic response is to just sell everything, or maybe worse, try to catch falling knives without any real reason. But the planned response? That's about assessing the situation, sticking to your core strategy, and using objective signals, not scary headlines, to make your decisions. You want to be in that left column, not the right one. So what does that plan actually look like? This playbook gives you four key moves. Number one, while fear is high, meaning the VIX is over 25, you keep your hedges in place. Number two, you anchor yourself. Hold on to your core long-term positions. Don't just abandon your whole strategy. Number three, set objective triggers. For example, use the VIX dropping below 20 as your signal to reassess. And finally, number 4, you have to resist that temptation to just buy the dip without a really clear thesis. Don't try to catch falling knives.
All right, we've covered the shock, the different scenarios, and the strategy. So let's pull it all together and talk about the big picture here. What's your next move?
And really, if you take just one thing away from all this, let it be this. For the better part of a decade, a lot of investors could get away with treating geopolitics as just background noise. That era is over. Geopolitical risk, from energy prices to supply chains, is now a primary driver of what happens in the market. It has to be a central part of how you analyze your investments from now on. So that leaves us with this final question. The old playbook, the one where the Fed would always swoop in to cushion the fall, well, it's been torn up. The market's insurance policy has been revoked, and this whole new layer of risk is now front and center. So the question for you isn't if you should adapt anymore, it's how.